Well, thank you all for coming. Uh, so I'll start by asking, I guess, how many of you would like to be a millionaire? Or maybe even have a few million to your name. So there's few certainties in life, but one thing is clear. If you do the things that we'll go over tonight, every one of you can have that kind of money. Okay? And it isn't about chasing riches. It's about becoming financially independent so you can have true freedom and control over your own life. And that's something that is worth, working towards. So no one should care more about your future than you do. Okay, but most people just have wishes in life. Most people really never take action to make sure that they secure their financial future. And that's what tonight is about. So I'd like to start with going over a few things that will hopefully give you a little bit of urgency of why you need to make sure that you start thinking about this today. So the first thing I want to do is talk about Social Security, because too many people in our society rely on Social Security. In fact, without Social Security, close to 40% of retirees would be under the poverty level. However, there's a problem with Social Security. Okay, since 2010, the amount of money going out is less than the amount of money coming in. So Social Security is not funded from Congress. It's funded through our paychecks. Okay, money is taken out through workers, through their paychecks, and it goes into the fund, and then it comes back out to retirees. But since 1960, there was over 5 workers for every person in retirement. Okay, so it was never funded. It's just people working today pay for those in retirement now. But in 1960, there was over 5 workers for every person in retirement. Now there's only 2.7 people working to pay for every person in retirement, and that is headed lower. By 2033, unless something is done, everybody's going to get a 23% pay cut, because the surplus fund that is in there will be gone by then, and then it will be limited to what's coming in. Okay, so any politician out there right now that tells us that, we can't touch Social Security, we can't do anything, we got to keep it as is either naive or lying to us, because something must be done or everybody is going to get a 23% pay cut, even those in retirement right now. Okay, so it needs some reform. So what will reform look like? Well, they've done it before back in the 1980s. Okay? They could raise the retirement limit, and I'm sure you don't like the sound of that you got to work longer. Okay? They could lessen what people get. Right now, it's only designed to replace about 35% of what you need. So it's not enough to live on. It's not a retirement plan. Okay, so you need to plan for your retirement on your own. Okay, they could also tax us more. They could, again, lessen the benefits or raise the retirement age. None of that is really a good situation, especially for the younger generation. So again, it's something that we need to take care of. And government is going to be able to do less and less all the time, because if you look at this right now, our national debt has been increasing at kind of an alarming rate. Right now, the total debt to GDP, so GDP is basically just the size of our economy, is basically as high as it was all the way back in World War II. And like I said, it's increasing at a very alarming rate. We cannot continue this path. In fact, these are very optimistic figures, okay? But before too long, interest will be the largest line item in our budget, okay? Which means government will be able to provide less services to people. So again, we don't want to put our future security, your future financial security, in the hands of politicians, because you probably won't like the decisions that they make for you. So you need to do this on your own. If you want to have a secure financial future, you need to do this. You need to take action now, because time is really important. So, are people doing it? Well, right now, this is from the Federal Reserve. These are the median size of what people have saved for retirement. Now, if you look at this, even people nearing retirement, 55 to 64, or those in retirement, 65 to 67, the median number is around 200,000. The median is the person in the middle. That means half of the people have less than that. And in fact, 1 out of 4 have less than $10,000 saved for retirement that's in that age category. That's really depressing, because if you think about it, there's what's called the 4% rule. If somebody had $200,000 saved up for retirement, I know that sounds like a lot of money when you're in college. However, if somebody had $200,000, if you want that to last throughout retirement without running out, you can only take out about 4% per year. Well, 4% of $200,000 is only $8,000 per year that you could withdraw if you want that to last like 25 years. That's not a very good retirement. Okay? So these are really dismal numbers that we're looking at here. And remember, that's the middle person. Half the people have less. Okay, so we need to invest, and we need to invest in the most efficient way. You can't just save money, because if you only save it, and let's say you put it in your sock drawer or under your mattress, or maybe in a savings account, which really doesn't pay much, maybe it earns a little bit of interest, but those are really the only ways you're guaranteed to lose money because of inflation. Okay. Because of inflation, let's say over a long period of time averages 3 or 4%, you're losing 3 or 4% every single year. So it has to be invested. You can't just save. Saving is just the first step, but then we have to put the money to work, so to speak. So let's look at some of the best types of investments that we could look at. Now, let's look at the last 10 years. What we're looking at here is what silver has done. Notice, actually, silver, we're looking at the last 10 years ending in 2022. Silver actually lost money. It had a compounded annual growth rate of a negative 2.5%. So if you would have invested $10,000 in silver 10 years ago, you'd have $7,763 left. Gold grew at less than 1%. Homes, the median home price, if we go back, it at least averaged at 5.4%. Now, this is a pretty good period for real estate or homes, because notice if I go back 10 years, that's shortly after the financial crisis of 2008 and 9. Okay, and then, of course, homes kind of bounced back and stuff. So this is a pretty good period for homes, but still it only increased 5.4%. Bonds, a lot of people like to invest in bonds. Over the last 10 years, it grew at 1%. That's really dismal. But look at the S&P 500. The S&P 500 is just a basket of basically the biggest 500 companies in the United States. Okay. And look what it did. It averaged 12.6%. $10,000 invested in the S&P 500 10 years ago would have more than tripled in value. Okay, so when we invest, we want to invest in the most efficient way, and we want to invest in the best investment, so it grows at a rapid rate, okay, without taking unnecessary risks. We don't want to do anything silly. Now, you might think, well, that's the last 10 years, but investing should be over a longer period of time. So let's look at the last 30 years. Okay? Well, metals did a little bit better there. See, silver averaged 6.46% over the last 30 years. Gold, 5.87%. Homes, the median home price over that period of time went up 4.4%. This is actually using the median home price from the U.S. Census Bureau, and also that's the same figure that the Federal Reserve came up with. But really, that's kind of an inflated number, because in 1993, the size of the homes were much smaller, and government only tracks the sale of new homes, not existing homes. So we're comparing new homes in 93 to new homes today, and homes today are 32% bigger. So we're not really comparing apples to apples. So 4.4 is a very kind of optimistic rate of growth for housing. Bonds did 3.94%, but again, look at the S&P 500, 9.66%. And that last column there you can see is what $10,000 would have grown into over that 30-year period invested in all of those different assets. So we see advertisements for you should invest in gold or silver, it's safe and all that kind of stuff. Over a long period of time, it has always done worse than the S&P 500, and so is real estate, so is bonds. Okay? Nothing is really ever compared with investing in stocks, which is sometimes referred to as equities. Now, these are actual figures that we're looking at here, but here's another study from BlackRock of the past 10 years, and this is actually past 10 years to date. So the stock market is up this year, okay, in 2023. But look at here, U.S. equities, that's U.S. stocks. 11.1% rate of return. And look at all of these other asset classes. Infrastructure, 4.4, Japanese equities, European equities, REITs, that's real estate investment trusts. So basically you're investing in real estate. Okay. High yield bonds, that's bonds, but high yield means they're referred to sometimes as junk bonds. They're a little bit more higher risk. But notice again, nothing really compares with stocks, U.S. stocks. And Vanguard, other companies have done studies that go back 100 years. And again, nothing compares with stocks. Okay, so if we are going to invest, especially when you're young, you should be investing in stocks. None of these other things. Now, so let's take a look at the S&P 500. As I mentioned, the S&P 500 is a very convenient way to invest because you can buy one share. You buy it just like you would any stock. But when you make a purchase, you automatically own a piece of 500 companies all at once. So you're diversified. And look what, this is a chart going back to 2005, okay? It has increased a lot over that period of time. And notice it never grows in a smooth line, okay? It's a little volatile, but all things are, okay? So here, the beauty of the S&P 500 is you don't really have to know anything. You don't have to study stocks. Some people are afraid of the stock market because they're thinking, well, I don't know how to pick stocks or I don't know how to do this. You can just make a simple purchase, buy one share, you automatically own a little piece of 500 companies. And you don't have to know a thing, you don't have to track the economy, you don't do anything. And we just saw the results of the last 10 and 30 years. Nothing comes close to the S&P 500. Now, what's in the S&P 500? Well, pretty much every company that you probably know. So here's some of the companies that are in the S&P 500. When we say we own a piece of all 500 companies, this is just the top 10 because your money as you invest in that is not divided up evenly between all 500 companies. The bigger companies get the majority of the money. Okay, so let's say you put $100, if you invested $100 in the S&P 500, right now, $7.33 essentially would go into Apple. Apple and Microsoft happen to be the two biggest companies, so they get the majority of the investment. Okay, but notice this is what you're buying. You're buying a piece of the U.S. economy. You're buying a little bit of all of those companies. So You're diversifying your risk. You're not trying to pick a stock. You don't have to worry about whether one stock goes up or down because you own 500 all at once. Now, if we look at what the S&P 500 has done, this is a compounded annual growth rate, which is how investments grow, okay, on a compounded basis. I have this other column over here because I want to talk about that just for a moment. The average return, that's what, like if you go to a financial advisor, okay, or some financial firm, and in their reports, they usually like to report the average return because it's an inflated return. But it's a little misleading because that's not how investments grow. Okay. I don't want to get too much into the math here, but if something goes down 20%, it's got to go up 25% to break even. So, but they like to do the average rate of return because it's an inflated number. Plus, when they report that, they very seldom ever include the fees that they're charging you. Okay, so the compounded annual growth rate is what you should be looking at if you're comparing investments. And you can see what the compounded annual growth rate of the S&P 500 has been over 5, 10, 20, and 30, and 40 years there. And that's why usually when people are talking about what the S&P 500 does over a period of time, we usually just say it averages about a 10% rate of return, which we can see here. Now, this is what's called a SPIVA report. It comes out every quarter, and what it does is it's a measure of all the different professional managed mutual funds that are out there. The funds that financial advisors like to use and put your money into if you go to a financial advisor. And what we're looking at here is a study that compares all of the professional managed mutual funds to their S&P benchmarks. In other words, are they beating the S&P? And they are not. If you look over a long period of time, that's what we should really care about, like a 10, 15, 20-year period, because that's your investment period. Okay. For most of you, longer than that. Look at that, around 90%, that's what we're looking at, 90% underperform the S&P benchmarks. And they're charging you fees. You're paying them money to manage your money for you. You're literally, essentially, paying them to do worse than you could just do on your own if you just bought the S&P 500. Because you can buy that with 0 fees. And you can buy it through like Fidelity. You can set up your own account through Fidelity, Charles Schwab, Vanguard. Those are usually the 3 I recommend. And when you buy the S&P 500, it doesn't cost you anything. Okay? There's a yearly fee that's 0.03%, 0.03%. It's so insignificant, it doesn't really even matter. So why would we want to pay management fees or have a professional manage our money or put our money into a mutual fund when 90% of them are going to do worse than you could just do if you just bought the S&P 500? Professionals, year in and year out, this is pretty consistent every single year when this comes out. Professionals, 90% of them cannot beat the S&P 500. So if they can't do it, you probably shouldn't be trying to pick stocks either. Okay, now, how are we going to fix all this? Well, let's look at some examples. If somebody is making $50,000 per year for 45 years, okay, we'll keep this consistent, the same $50,000 for 45 years, they would make $2.25 million over their entire lifetime in earnings. And of course, that's not all theirs. They would have to pay Social Security tax, Medicare tax, income tax. Okay, so this is gross earnings. That's not your take-home pay, of course. Now, what if you saved $300 a month if you were making $50,000 a year? That's only 7.2% of your salary. Think about that. For every dollar you earned, you just made the decision to save a little over 7 cents of that. So, what if you did that? Okay, so here we're looking at a calculator. We're investing for 45 years, the exact same $300 every single month, never increasing it. And it would grow into $2.7 million. That's the power of time. That's the power of compounding. And you have the advantage because you're still young. Time is the most important thing when you're talking about investing. Now, notice you only made $2.25 million. And you were only saving a little over 7% of what you make. And it grew into $2.7 million. It grew into more than you even made by working over your entire life. This is why it's so easy for you to do this. Every one of you can become financially independent and have complete freedom and control over your own life. Now, what if we did the same thing, but you were paying a 1.5% management fee? That's pretty typical. Like if we go to some financial advisor and some financial firm, okay, there's kind of layered fees. Okay, so all of them together. Okay, this is a pretty typical fee a lot of people pay. Some people pay 1 or 1.25. Some people are paying 2 and 3. So I'm just using an average here. So at a 1.5% fee, remember we had 2.7 million? So now instead of the rate of return of 10%, which the SP 500 has done, now we had to pay a 1.5% management fee. So now we're only making 8.5%. And of course, this is kind of giving them the benefit of the doubt because most of them do worse. So we're assuming they can at least do as well. Okay, so what happens? Instead of 2.7 million, you just lost $1 million in this example because you paid a 1.5% management fee. What? A 1.5% management fee sounds so small to people because they think, well, yeah, I don't mind paying somebody 1.5% to manage my money so I don't have to worry about it. They don't realize what it's costing them over time. In this example, it just took away $1 million that you could have had. Okay, so we have to focus on fees. We have to keep fees at a minimum. Fees are so important. Now, in this example, we kept the same $50,000 consistent over 45 years, and that's not really realistic because inflation happens, you get pay increases and things like that. So let's take a look at a little bit more of a realistic view. Here we're starting someone and they're going to start with $50,000 a year and with a 2% annual pay increase, and they're going to work for 45 years. Now, in this example, they would make almost $3.6 million in gross earnings over their entire working career. Again, that's gross, that you don't get to, that's not all yours. The government's going to take a big hunk of that, right? Okay, they're going to take Social Security taxes, and Medicare taxes, and federal taxes, and probably state taxes, unless you're in a state that doesn't charge it. But $3.6 million over your entire working career. That's what you earned in gross pay. Now, what if you decided to save 10%? For every dollar you make, you're going to save 10 cents. That's it. It would grow into $4.4 million. Again, more than you even made by working over your entire life. Again, this is the power of time and investing, especially when you start young. And this is why it's so easy for you to do, especially if you get started at your age. But every year counts. Most people never think about retirement until they're in their 40s or sometimes even 50s. And then it's really difficult. Much more of a sacrifice then. But it's very little sacrifice for you if you get started at a young age. Now, what if, notice this was growing at 10%, like the SP 500 has always done in the past, and we're never guaranteed what the future will hold. Okay? But if I look at last 10, 20, 30, 40, 50 years of the SP 500, it's averaged about 10% rate of return. But what if, again, what if you were paying a 1.5% management fee? Instead of 4.4 million, now you only have 2.8 million. Again, 2.8 million sounds wonderful, but not if you know you could have had 4.4. Okay, so again, fees are so incredibly important. You have to keep the fees at a minimum. Usually if I'm talking to somebody and if they're looking at a fund to buy, okay, you can always find any fund that somebody's interested in buying. There's always a comparable fund that has a management fee, or not a management fee, but what's called an expense ratio below 0.25%. You can easily find them below 1/4%. But the SP 500, you can buy that with 0.03%, 0.03% fee. So again, fees are so incredibly important. Okay, so now let's look at what it would take for somebody to accumulate $3 million. That's not a bad sum. Probably be happy with that. So again, this is for somebody starting with a base salary of $50,000 at the age of 22, maybe you're just out of college, and retiring at 67. By the way, that's currently your full retirement age, defined by Social Security. Now, that could change because Social Security has some problems we looked at. But right now, if you want, that's what Social Security defines your full retirement age. Now, you can take it a little bit less than that or earlier than that. However, then you get less. So notice if that person started saving only 6.5% of what they made in this example, it would grow into $3 million. If you start right out of college, you don't have to sacrifice much. And you could have $3 million when you get ready to retire. Now, maybe you can save more than 6.5%, and then imagine what you could have. You got to remember, when you're young, most of you are probably semi-broke kind of now anyway. You're not used to having much. It's so easy when you get out of college and you start making money to just don't inflate your lifestyle a lot. Continue to live poor just for a little bit. Okay? And save like crazy. What you do in the first 5 or 10 years of your life right out of college, if you want to do this, is so incredibly important. Now, if somebody waited to the age of 30, notice now they got to save 12.3% of their salary. And instead of saving $271 a month, they would have to save $600 a month to get to that $3 million mark. A little bit more of a sacrifice because you didn't start right away. You thought you could wait till you're 30. What if they waited to the age of 35? Well, now they got to save 18.5% of their salary. And they would be having to save $997 a month to hit that $3 million mark. So almost $1,000 a month. That's going to be a sacrifice. That's going to be a little painful for a lot of people. What if they waited to the age of 40? Now they got to save 28.2% of their salary, or $1,678 a month, to try and hit that same mark. And what if they waited at the age of 45? Now they got to save 44% of their salary, or $2,890 a month. Not very many people are going to be able to do that. Okay? So they're not going to probably be able to accumulate what you could with just a small sacrifice. If you wait, it's really difficult to catch up to somebody that started young. And look at the total invested. If somebody starts young, because they're investing such a small amount each month, over their entire working career, to get $3 million, they only invested about $233,000 of their own money. And it grew into $3 million. But if you wait, you gotta put in and invest much more of your own money to hit that same mark. Okay? You're doing it over a shorter period of time, but the sacrifice every month is so huge that you actually end up investing more of your own money. So hopefully, as we go through some of this stuff and you see how easy this is for you to do, hopefully you leave here tonight excited that you can determine your own financial future. Notice, if you start young, you don't have to make a lot of money to become financially independent. You just have to get started young and stay with it and save and invest every month. Okay, now, when it comes to investing, one of the biggest things that we need to do is be able to control our emotions a little bit. So I want to talk about that just a little bit, because we're talking about saving and investing every single month. And we looked at that chart of the SP 500. It's a little bit jagged. Okay? It's not a nice, smooth curve. So let's talk about emotions just a little bit, because it's really important to control your emotions. What we're looking at here is a little chart from 1987. I know that's a long ways back. But I'm highlighting this because it's the single biggest crash in one single day of the SP 500. In October of 1987, in one day, the SP 500 dropped just slightly over 20%. It went down 20% in one day. Now, that causes a lot of emotion and fear in people. And it happens all the time. In 2008 and 2009, the housing crisis was going on, and people were panicking and emotional and, selling and all this kind of stuff. So, what should we do during periods like this? Well, first of all, you should never be emotional. And investing should never be exciting either. If you want excitement, take some money and go to the casino or something. Investing is not something that should be exciting. Investing done correctly should be rather boring. It's just part of your life. You just save and invest every single month, and you do it consistently, and you don't care whether the market is up or down. You just do it every single month. So this is the worst single day in history in the stock market. Now, we're zooming in on one specific period of time, which is always what causes emotion. But now let's zoom out. This is a long-term chart of the SP 500, going back to a little before 1987 and all the way up to today. I want you to look over here in the corner. See that little circle there? What I have circled? That's 1987. That's that huge crash. That's the biggest single crash ever in the market. And look at that. It's completely insignificant now, isn't it? It doesn't matter. Okay? And that's why you shouldn't become emotional when the market's down or get excited when it's up. We care what it does over a long period of time, and we just looked at what it does over a long period of time. That is a completely insignificant moment for a long-term investor. And notice shortly after 2000, the market kind of went down there for a while. Went down for about 3 years in a row, actually. And what we had, what was called the dot-com bubble, and then we had 9/11, so a lot of things were happening. And the stock market didn't do very well for a while. And then, of course, shortly after that, in 2008 and 2009, we had the housing crisis. People were emotional during that period of time, too. They made movies about it. And did you know that in another decade or so, a few years down the road, those two periods are going to look just like that little period I have circled. They're going to be insignificant periods of time. So you shouldn't care when the market goes down. In fact, if you're not very close to retirement or in retirement, you're in your 20s, your 30s, your 40s, you should be hoping the market goes down. Why? Because it's on sale for a while. Americans like sales. I bet when you like it when you go buy clothes or whatever and stuff is on a sale, you know. Why shouldn't you like the stock market when it's on sale? Those are your best periods for somebody that is just consistently saving every single month. Those are the best periods for you. You should be happy when the market goes down, even if it's down for a year or two, and everybody around you is emotional and panicking and wondering what they should do. You should just kick your feet back and be happy because you're buying it on sale for a while. And over the long run, you're going to make even more money. Okay, so there should never be emotions when doing this. We want to understand what we're doing and understand what the market does over a long period of time. People are too focused in the short term. Investing is a long-term endeavor. All right. So, I'd like to finish with a few tips for your financial success. No, as I said at the beginning, nobody should care more about your financial future than you do. You don't want to put your financial security in the hands of anyone else. You may not like the decisions they make for you. You need to take action and do this right now. And it's so easy to do if you start when you're younger. The younger you start, the better. Okay? Even if you can only save $50 a month, you want to just get started. Because it's about building a habit. It has to become a part of who you are, what you do. It's just something that you incorporate into your life and you make it a habit. And you want to secure your financial future. If you ask people right now, there was just a recent survey of people in retirement. Over 70% of them said the number one piece of advice that they would give their younger selves is to save more, invest, and start earlier. The thing is, you can't ask your future self. You have to care about your future self now. So, that's the first thing. Visualize the life that you desire and make it happen. You can do it. You just got to start. And therefore, you got to begin right now. That means now. Every year matters. And if somebody is watching this or listening to this, okay, or in the room, and maybe they are older, maybe they're 30, maybe somebody's 40 or 50. I don't care whether you're 22, 30, 40, or 50. I can promise you one thing. Once you know this, 5 or 10 years from now, you will regret that you didn't start today. So some people might be 30 or 40 or 50. Okay? Maybe you want to talk to your parents or something. And most people wish they would have saved more, or maybe they haven't started yet. Okay? I'll guarantee you 5 years from now, they wish they would have started today. We can't keep kicking the can down the road and not taking action. It might seem unrelated, but you want to build a strong credit score. People underestimate how important that is in life. If you have a really good credit score, your car insurance is going to be much cheaper. If you own a home, your home insurance will be much cheaper. If you're applying for a job, more and more places are checking your credit score. Having a poor credit score could disqualify you from certain jobs. Maybe you want to rent a place in the city. Landlords are checking credit scores. It may knock you out of getting the apartment that you would like to rent. And I'm talking about like car insurance and house insurance, let alone just interest. If you borrow money to buy a car, if you borrow money to buy a house, your interest rates are much lower, which dramatically affects how much money you're able to save and invest. So, build a good credit score. Know how to do that, what affects it. Okay? It's really important. Have an emergency fund. We want to save and invest, but it is really important to have an emergency fund, because one thing you don't want to do is take on unnecessary debt in your life. When you borrow money, you're kind of stealing from your future self. In fact, when you borrow money, you're automatically placing a burden on your future self, because the only way you get out of debt is to live on less than you make in the future so you can try and pay off that debt. So an emergency fund is really important because there's always unexpected things in life. Your car could break down. Got to get a new transmission. You've got to buy a new refrigerator. Something always happens. And unless you have an emergency fund that you're able to take care of that unexpected expense, most people end up going into debt to cover that bill. Okay, so an emergency fund protects you from falling further into debt when those things happen. So build an emergency fund. Okay, invest in your financial freedom, not your lifestyle inflation. Let me explain what this means. Most people, when they get out of college, we start making money, okay? And we make a little bit more money, we get some pay increases. And we want to improve our life, which is great. But most people just keep spending what they make. They just buy nicer cars, or they live in a nicer house, or they take more vacations. Did you know right now in our society, over 30%, it's about 31% of people making over $150,000 a year are living paycheck to paycheck, struggling to make bills. You wouldn't think that should be that way, but their lifestyle has just increased right along with their wage, and they're not saving and investing. I know people making $300,000 and $400,000 a year that are living paycheck to paycheck. Everybody thinks they have a lot of money because they're living large, let's say, but they have no net worth. They have to keep working to try and cover all of their expenses. Okay, so remember, when you're first starting out, you're not really used to having a lot yet. So once you start making some money, take that opportunity to save aggressively when you're young. You want to build financial security before you start buying stuff that brings you pleasure. If you do that the other way around, you'll always be broke. Okay, opt for a discount broker. Remember we said that if we go to a financial advisor, we're paying them a bunch of fees, and they're going to put us into actively managed mutual funds, paying a bunch of fees. And those mutual funds do worse than the SP 500 anyway. So we want to opt for a discount broker where we don't pay any fees. And that would be like Fidelity, Charles Schwab, Vanguard. Those are all great places. I'm not making any recommendations, but those are all three really good choices. We need to avoid fees. Contribute to your employer's retirement fund. Most of you, when you get a job, most places offer a 401k. Some places offer a Roth 401k, but you should participate in that. It's sad that so many people that have access to a 401k through their place of employment don't even participate. So how it works is you sign up and maybe they agree to match 5% of what you put in, or they agree to match 5% of your wage. So if you put in 5% of your pay, they match it. You double your money the very first day. So whatever they're going to match, how much of your salary they will match, always put that much in because you're doubling your money the first day. But only up to the match. If they match 5% of your salary, typically don't put in more than that at first, because places, 401ks through your employer typically have a little higher fees. But because you double your money the first day, it's still a wonderful deal. So always do that. Now, consider the SP 500 as your investment. Notice you don't have to know a thing. You just buy that. And you're better than 90% of professionals. Pretty easy. You don't have to know a thing. Remember those big amounts that we were looking at, where you could have 4.4 million, you could have 3 million, and how easy it was for you to do? If you invested that in a Roth IRA, an IRA just stands for Individual Retirement Account, which every one of you can set up through Fidelity or Charles Schwab, any of those places. And then if you invested into a Roth IRA every year, that entire amount at the end is income tax free. You will not pay any income tax on it whatsoever. It doesn't matter whether you take out $50,000 in 1 year or $500,000 all in 1 year. It's all income tax free. That's the beauty of a Roth IRA. Some companies offer a Roth 401k. Okay? If it has Roth in front of it, the entire lump sum at the end is income tax free. That's a huge benefit. Got to sound good. Remember we looked at the deficit that the government had and the projections? I feel pretty confident that in the future, taxes are going to be higher. They're going to have to be. And that includes everybody, not just the rich. So a Roth IRA will protect you from that. So start a Roth IRA for your security and a source of tax-free funds. Really important. So that's why you invest in your employer's 401k up to the amount that they will match. And then if you can invest more than that, you would want to set up a Roth IRA and invest more there. Okay? Because that'll be income tax-free at the end. The other thing, we're investing, right? So you need to embrace volatility. We looked at those charts. There's going to be times where the market goes down and everybody around you is panicking. And in fact, the news loves it. And they try and sell fear. So people come back and watch the news more. And in fact, the news media tries to even create more fear and panic. I mean, that's what they do on a daily basis, pretty much. So you got to remember, when the market's bad, you should be happy. You're buying it on sale for a while. And in the long run, it's going to help you. You know what it does for a compounded annual growth rate over a long period of time. That's what you should feel confident about. What it does in any given year, or even over 1 or 2 years, is irrelevant. It doesn't matter. If it's bad, be happy. You're buying it on sale. You need to resist using your retirement funds, though, prematurely. And it's tempting. Most people, first of all, don't save and invest. But the ones they do, the other thing that happens is kind of sad. Eventually, there's going to be a lump sum of money in there. And it's so tempting to take that out and buy something you want. You got to remember, that's for your future self. You got to view it as off limits. You got to protect your future self. So you got to make sure you leave it alone. View it as off limits and just keep saving and investing every month. Don't be tempted to take it out and buy a car or go on a vacation or anything. That's for your future security. And if you ever take it out, remember, time was the most important thing. You can't get back that time. Okay, so view it as off limits. Don't spend first, save first. What I mean by this is, a lot of people always have good intentions. They think, well, I'll see what I got left at the end of the month, and whatever I have left, I'll save it and invest it. If that's your attitude, you'll never do this. You got to make sure it's the first priority in your budget, the first thing that comes out. It's like rent. Even before that, it's the very first thing that comes out of your paycheck. How much you're going to save and invest every month. And then you live within your means and you live on what's left. Don't think you'll save what's left at the month, or you won't do this. Save first, live on what's left. And the last one, you must continue to expand your knowledge in the financial area. Tonight is just your first step. Hopefully, we've covered some things that excite you, that show you how easy this is for you to do this and secure your financial future. But there's a lot of things that, we can't cover in just one talk. And I'm sure many of you still have questions. Okay, so you want to make sure that you continue this journey. It's sad that, sometimes somebody's going to buy a TV and they'll research and read articles and read reviews and try and figure out which TV to buy. Or it could be something else, of course. And yet, so many people don't do anything to learn about retirement accounts and the most efficient way to invest and things like that. Again, you should care about your future. If you're not trying to learn about this stuff, you don't care as much about your future as you probably think you do, because you want to secure financial future for yourself so you have freedom and control over your life. That's what's important. So if you want to continue, okay, I do have a YouTube channel where I get into some of this stuff in a lot more in detail. And these are just some of the videos, but you're welcome to follow along here. I plan on putting up more videos in the future. Okay, but for example, if you want to learn more about IRAs or other types of accounts that you can use for retirement accounts, like an HSA or whatever, you can certainly follow along here, and it would be, one good source. Not certainly not the only source. So anyway, I hope you do leave here excited. I hope you take the steps to secure your future, because it is easy to do, especially at your age. If it's a little bit later, okay, people can still do it. They just have to make more of a sacrifice. But at your age, it's such a small sacrifice. If you don't do this, I promise you, you're going to have regrets that you didn't start. So, thank you for coming. So, if you invest through a Roth IRA or a Roth 401k, that type of retirement account that has the word Roth in front of it, then that entire amount at the end is income tax free. You will not pay Social Security, Medicare, federal tax, state tax. There is no taxes whatsoever. Yes. So, okay, so yeah, there's so many things if I would have covered everything in detail, this thing would have been like 3 hours long. But, so when we set up, let's say, an IRA, that's just an account. Think of it as like a bank account or a savings account, okay? It's just a retirement account. And then we put our money in there, but then it's just sitting there for right now. Then you have to invest it. So then you invest in the SP 500. And so when you own the SP 500, it's inside that IRA. So there wouldn't be any taxes. Now, if we own it someplace else that's not in a Roth or something, then you would pay some taxes on the profit. But you don't pay income tax, you pay capital gains tax, which is a lower rate. But actually, I have a video on how to buy the SP 500 and what it is and how to do it and stuff like that. So, you know, that would be a good one to kind of probably go through and answer a lot of those questions. Are you laughing at all my pictures? Yeah. Oh, an emergency fund is basically, we need to save some money. Now, usually we're talking about tonight saving and investing for your future. But an emergency fund is really just that. It's for unexpected expenses that come up along the way, like that could happen next week or next year. Okay? Your transmission goes out in your car or whatever. And an emergency fund, then, that money shouldn't be invested because you might need to use it at any point. And remember, like stocks and stuff can go down in value. We wouldn't want to have to sell and take our money out when the market's down. So the amount that's in an emergency fund should just be in something very safe that can't go down in value. There are savings accounts right now that is paying 5 and 5.5% interest, so that would be a good place to put it. And and ideally, when you're young, you probably don't have much in an emergency fund. But over the course of years, once you start working, kind of the goal that we should have in general is eventually have enough emergency fund for about 6 months of all of your expenses. In other words, if you got hurt and couldn't work, or you lost your job, or something really bad happened, could you pay all of your expenses, rent, car payments, everything, food? Could you cover your living expenses for 6 months? That's really kind of like the ideal amount that we should eventually have. Now, it takes a long time to get there when you're just starting out. But ideally, that's a really good, healthy emergency fund. Yes?
How do you think is a good way to determine what percentage of your income to invest?
Good question. It depends so much on how early we start in life, as we saw. You know, like we looked at an example if somebody did start at 22 and they were making 50,000, you know, what they could have if they only saved 6.5%. Well, you should really be shooting for more than that. You know, if you start really young, in your young 20s, try and save at least 10 or 12%. Now, it's tough sometimes because you're just starting out. Maybe your wage isn't real good at the beginning. You're paying rent. Maybe you got a car payment. Maybe you got student loans. But, you know, if you can't save that much, then save what you can. But, you know, look at your budget, track your spending maybe for a month or two, see where you could cut back. But if somebody doesn't start until they're 30 or 35, they need to be saving like 18, 20% of their gross. Okay, so it really depends on how early you start in life. You know, a lot of times I talk to somebody in their 40s or something, or in their 50s, and they haven't started. Well, then they need to do everything they can to be pretty aggressive, cut back all unnecessary expenses, and save as much as they can. Yeah. At the end, so we do pay the money that we put in. There's really two types of IRAs. So if I have a video on IRAs, but comparing the two. But there's a traditional IRA. So on a traditional IRA, if you make $100 today, you don't have to pay taxes on it if you put it into what's called a traditional IRA. But then, if we keep doing that, and that great big lump sum at the end, when we pull it out, you're going to pay income taxes on that. And I think income taxes are going to be higher in the future. Now, a Roth IRA is just the opposite. If you make $100 today, you got to pay your taxes on that first. And then you get to invest what's left. But then as it grows, that great big lump sum at the end is completely tax-free. No taxes whatsoever. Yeah. Oh, so it's basically when you get your paycheck, you know, they take out taxes. They take out your federal income tax. So basically, you have to first pay your federal and state income tax. And then invest. You always pay your Social Security and Medicare on either one. But on a Roth, if you're investing into a Roth, you first pay your federal and state taxes today. But then the lump sum at the end is all income tax free.
Yeah. What advice would you give for someone going to professional school? Would you try to invest while you're there for 4 years, or would you just?
So that's difficult. If you're going to an expensive professional school, if somebody's borrowing money to do that, it's kind of depends on each individual. But usually, I always recommend it is good to build the habit of saving and investing what you can and continue with that. But it does vary a little bit for each individual. Especially though, you know, you never want to borrow more than you need to. You know, so it depends on what the interest rates are. If interest rates are really high, and they are now, okay, it's usually best not to take on more debt than you need to. But then, if somebody is going to professional school, here's where you can really make up the difference. Let's say somebody's going to be a doctor or dentist or come out lawyer or whatever. They're going to come out and have a relatively high income. Notice when you start that job and you start earning that high income, you're still used to living poor. So improve your lifestyle somewhat. That's great. Just don't spend all of that. You have the opportunity to save like crazy. What if, let's say somebody starts out making $300,000 a year. What if you lived like somebody making $150,000 a year? You'd think that was wonderful. Could you imagine how much you could save? Start saving $40,000, $50,000 a year those first few years. Okay, so if you come out of professional school and you have a pretty high income, don't inflate your lifestyle too fast. Yes, enjoy your hard work that you put into that. You know, improve your life. Okay? Get a nicer place to live and take some vacations. But you can save like crazy if you just don't inflate your lifestyle as fast as your income. So take advantage of that. I suppose you're ready for your... Oh.
I have one more question.
Yes. Yep.
Kind of going off of that, if you have like a higher amount of student debt because you go to professional school or something, do you think it's better to like put 300 into your debt or whatever and 300 into the S&P, or do you think it's better to pay off all of your debt right away?
Again, a lot of times those student loans have such high interest rates. You know, it's kind of a double-edged sword, because I really do believe in building the habit and saving and sticking to that through thick and thin always. But when you're paying, if your student loans are 7.5%, 8% interest or whatever they are now, okay, if you're paying that off, that's like earning 7.5% or 8% with no risk. So you want to try and get out of debt as early as you can. Now, it depends on what type of career you're going into. Okay, if somebody is going to be a medical doctor, let's say, they come out of professional school, and the majority of them, when they sign their first contract, get like student loan relief, or they get a signing bonus to kind of take care of student loans, and that can be a couple $100,000. So that can wipe out a lot of that debt. Okay, but other types of careers, of course, don't have that. But so again, it kind of depends a little bit on each individual.
When would you recommend not paying off the debt first? What is the interest number that you consider as the threshold?
So think about like right now, if somebody bought a house today, the average interest rate is 8%. Holy cow, that's high. However, somebody that bought a house a couple years ago, at one point, some of those loans are at like 3%. If somebody has debt on a house or anywhere else it's maybe only 3%, 4%, or 5%, then they should probably not pay that off faster than it needs to be. Just make the payments, whatever the minimum payments are. Just make the monthly payments. Don't ever miss a payment. That hurts your credit score. But, and then invest the rest. Save and invest. But if the interest rates are where they are today, then you need to get out of debt. The interest rate is just a killer. Okay, but like if somebody has a home loan at 3 or 4%, they should not pay that off rapidly. They should just make the regular payments and save and invest more. The sad thing is that most people don't save and invest. But hopefully you do.